Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and in investing. I'm Stacy Smith, and I urge you to say that you like or subscribe to this program on whatever platform you happen to be using. Well, the volatility in the stock market continues, but have we seen the bottom? We'll take a look at that, and we'll also talk about the apparent standoff between the president and the Fed chair. It is coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies in Pittsburgh, Frank Crissetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thanks again for joining us for The Bull, the Bear, and You. You know, the markets have rebounded some from the lows that were set the last time we met 2 weeks ago. That rebound, of course, was triggered by a pause in implementing the across-the-board tariffs proposed by the Trump administration. However, the markets are still down for the year, with the Nasdaq down more than 15%, the S&P 500 down more than 10%, the Dow declining 8%. So my question, and Michael, I'll start with you, is if, and I stress the word if, we have seen the bottom, what would make you think we have seen the bottom, or what would you make you think we've ever seen the bottom?
I think it's a big if because I don't think we've seen the bottom quite yet. And I think that the one thing that will cause the bottom to be in is if and when these trade deals get resolved or something really with something gets done with China. That's the impetus for all this trade stuff we're seeing. So I feel like in any kind of webinar you do, podcast, radio show, you have to not only timestamp it with the date, but you also have to timestamp it with the exact time that you're speaking because things can change minute by minute with what's going on from a news cycle standpoint. So we're recording this on April 24th or April 21st at 10:50 a.m. The markets are down 2%. I guess Trump's comments on Powell, Trump's comments on the trade aren't really doing well for the market. So as soon as the rhetoric gets sort of resolved, I think that's when the bottom is pretty much in.
I was afraid some of you was going to say, well, you know, when the bottom's in is when we don't touch it again. But
it's probably true.
the current bottom.
I think it's interesting because at the end of the day, we have to understand and keep in the top of our mind that the stock market represents prices and valuations of companies. So, it's really trying to figure out how the rhetoric is going to impact those specific companies. And I think that as we get through the second quarter and really start to hear second quarter earnings, we're going to have a little more guidance on that. First quarter earnings, it's a little bit of a look in the rearview mirror. It's a little bit of how companies are positioning. But ultimately, we kind of need to get a little bit of a better feel. The other thing is that as we've compared this decline to what happened during COVID, because it's all related to supply chains in essence, the market did hit a bottom in March, a month in to the crisis. However, the most volatile days actually happened over the summer in June. So, have we hit a bottom? I'm not sure. Is there more volatility in store for us? I think so, to Michael's point, until we get some clarity, at least through this next quarter on, the political landscape, but then also get better guidance from corporations when they report second quarter earnings.
We're going to get into that in just a moment, but Kim, go ahead. What are your comments?
So I think what is at the heart of your question is the volatility of the markets, the up and downness of it all. And that to many people, most people in the markets represents risk, right? That's how most companies that are proffering sell-side advice are saying a volatile stock, something that moves not with the market, but either faster than the market, it goes up and down, that is a risky stock. And I'm going to say that is a definition of risk, but not the one that I choose to use. Risk to me is, am I going to lose the value of this thing? Am I going to have to sell it before I need to? That's my biggest risk. And am I looking at this asset, which is usually a company, correctly? Now, we have longer term views, which is what I espouse, because I don't know anybody that can, even on calm days, say where the price of a stock is going to end up. So it just feels more dire than I think it really is. If you look at your portfolio and if you have individual securities, that those are a collection of companies that are doing their very best to try to serve their customers and return shareholder value. And I think if you buy into the market goes up and goes down, and that means risk, it's going to be a tough summer for you here, again, until things get worked out with respect to the supply chain and, winners and losers in that.
I've said this on this show before, but there's two words, risk versus risky. And risk means it goes up and down, which means if you own a good company and it goes down, so what? If it becomes too small of a percentage of your portfolio, you might add to it when that happens. But then again, there's risky, and that's companies that go away. Those things you want to stay away from. And what's happening now, and it's most apparent in the bank earnings that came out last week, they all had operating earnings that were pretty interesting, but they had big beats because their trading desks made a lot of money because of this volatility, which I find interesting, and it reminds me of back in the days when I started in this business and we did nothing but buy stocks. When we measured a bank's earnings, we measured it without trading profits because those come and go. And we measured it based on their operation, not the trading desk and how they did. And that somehow has been lost in this market today. Kim, you're nodding, so I tell you, you're still doing that, I trust.
Taking out the earnings?
Without their trading profits.
Yes and no. I mean, if you look at companies like Goldman Sachs and Morgan Stanley, especially Goldman Sachs wasn't a bank, it was a trading house. I think that, the trading,
Yes.
the trading proceeds are very germane to what they do. They're not like PNC. But yeah, if PNC is making money off of proprietary trading, who cares?
Right.
Yep. All right. Well, that leads us right into the next section I'd like to get into, and that is companies are now reporting their first quarter earnings, with most reports coming in, if I'm not mistaken, Kim, between April the 28th and May the 16th, late April, mid-May. So can we glean anything? Frank just mentioned about the banks. Can we glean anything right now from the companies that have already reported? And have we figured out, or are they saying what they think their long-term or short-term future is going to be because of the tariffs?
I'm going to break everybody's heart, and maybe yours mostly, Stacy. No, we can't. It's the banks always report first because, oddly enough, tallying what happened in the quarter, they do it every day. They have to close it. They have to know how much money they have in their bank literally every single day. So they can do a rapid quarter end, tally of what happened, right? The rest of the companies, they need some time. Now, I love listening to the banks first because that gives you a coincident snapshot of what's happening right now with the economy. That's all the good they are. They can tell you what happened in the past and right now, but they have a terrible view into the future. And why is that? Because they don't really have a pipeline. Sure, they have deals that they're working on with various individuals and companies to lend money, but that can go away. Like, you can decide not to borrow the money right up to the time you sign on the check. So their pipeline is completely meaningless as to how the economy's going. Now, in this next week, and then really the week after, we are going to get some really great data on how the world economy is doing. And, I hate to say it, in the world of AI, is it still a thing? I think we're going to get a big yes on that because we did hear from Taiwan Semiconductor this last week, and things look pretty good with respect to AI. But no, we need to see what the companies say in this next coming week. So pay attention, everybody.
I've talked to a few of my industry sources, so to speak, in the retail business, asking them how's it going. with the thing, and they don't know how it's going with the tariffs. They can't tell any more than the rest of us. And their comment basically is the first quarter looks not too bad, but they're wondering if it's because of the weather or, well, the weather held it down, but then again, are people spending money ahead of this tariff thing, and it's a head fake, if you will. They don't know either. That's their concern. So as these earnings start rolling out, it'll be interesting to see what Kim always likes to talk about, which is what the people who announce this are going to say about the future. And Carrie, you alluded to the second quarter. That's the future. That's the quarter we're in.
Yeah, and I think it's important to be watching the data. I mean, the data that comes out, pretty much every day is going to give us a better look into the consumer's mindset, where inflation is. Something that I don't know that we'll talk about today, but the concerns about interest rates and the treasury auctions, and how successful they'll be. There's a lot going on that out there in the environment that isn't related to the stock market. It's really related to interest rates and so forth. But at the end of the day, the two things that the administration, the Federal Reserve, the two things that can't be controlled are how consumers behave and the prices that corporations set for their products and services. And those two things are what make an economy. So pay attention to the data, not just, the kind of dialogue that's coming across our screens every 5 minutes.
There was an interesting article I felt in the Wall Street Journal over the weekend by Juliet Chung that dealt with how the very wealthy are positioning themselves during this market turmoil. And there were three basic takeaways, and that some are selling stocks over fears that the prices of the stock are going to go down because of the tariffs. Others are buying the dips, taking advantage of the lower stock prices, and still others are taking a look at their portfolios and then turning the computer off and walking away and doing something else. So how are your clients reacting? Is one approach right now seemingly better than the other, or is it really too early to tell?
Well, I can start by saying that, we've talked about this before on this show. Selling stocks is the easy part. Who doesn't want to sell in market turmoil? I think everyone wants to. But when you come to the realization that you're not going to know when to buy back in, that's a problem, because the sirens are not going to go off saying now's the time to put your money back in. So if that idea is off the table, then you really have to look at the benefits of long-term investing and understanding your risk tolerance, how much you should have in a market that can wildly go up and down, and know that over the long term, that your investment strategy is aligned with your risk tolerance, and the quality of what you own is also aligned with your risk tolerance.
I
Go ahead,
think
Kim.
the changing information we get from the administration, and I have no dog in the hunt. I am apolitical here, but this is just what's happening now, that we get tariff information that differs from the beginning of the day to the end of the day. And it's very difficult for even really rich people that have a ton of resources to know what to do with that information. And I think the hardest thing to do is to have that longer term perspective, because it feels good to take action, but is that the action you should take? And my final little thing that I can never get out of my mind here is, you have put some money in the market. And the market, by definition, the prices change daily. And it's your desire to have some number that you can't go below is sort of like being at low tide at the sea. How are you going to change that if the sea goes out, the sea comes in? There's lots of factors that affect how high or how low the tide is. And it's the same thing here. You have to know, the tide will come in again. Prices will return, things will normalize. So that's my advice. I look at it like the sea.
And if you take it one step further in this market, you might quit looking at the indexes and start looking at specific companies or specific management styles that play into specific types of companies. Because there are companies out there that have gotten beat down that have very good businesses. And they're just down because, as Kim alluded to, the tide went out. And, when the tide comes in, all boats float. And when the tide goes out, all boats go down with it. And there are many companies that have become good. And if you're going to try to pick the bottom, good luck. Because it takes luck.
Well, there was an interesting comment on Bloomberg over the weekend, and that is that the tariff war has triggered an all-out plunge in returns across investment strategies, writing everything from U.S. stocks, big and small, to cryptocurrencies and corporate debt. In the grip of the tariff, about 90 of the top 100 best-performing exchange-traded funds of last year are down this year with an average loss of 13%. So my question to you before I continue with this is that about on average what most of the markets are down? I mean, most of the stocks, or is it, because aren't these ETFs kind of a combination of different sectors of stocks?
I don't have an answer.
Well, I mean, what I would say is it's very hard to take a kind of a composite like that
Okay.
and say, well, this is reflective of what, an investor's experience is. Because you can look at different exchange traded funds that do very different things and have a very different risk profile. And so the variation of those returns can really be wide. Where as an investor, if you're really wanting to understand how your money is doing relative to an index, you have to make sure that you're looking at the right index and the right allocation, right? If you have 60% in the stock market and 40% in bonds, you don't want to compare that performance to an ETF that invests in the S&P 500. Maybe you take 60% of that index and then take 40% of an exchange traded fund that invests in bonds, and maybe you're getting closer to being able to understand what the expectation should be or could be with the portfolio that you currently have.
All right, I'm going to throw this one out as well, and this goes on to that one particular article from Bloomberg, and that is that traders are plowing into havens such as cash and gold with proxies for both getting windfall inflows. So is that a place to go sometimes if you're just fearful?
I'm going to tell you, after 52 years of working in the industry with clients, probably when it makes the newspaper, the trade's over, and it's time to do the opposite. Because when all that money comes out of gold and cash, it's going to push whatever asset it goes into up. And if it's made the paper that this is happening, that means it's history. And now we have to figure out what's going to happen next or when it'll happen, which is the thing about trying to buy the bottom. Forget about it. And with the ETF thing that we were talking about earlier, I think there's more ETFs than there are common stocks now. And
Could be.
that being said, they're in so many different permeations. Who's buying gold? Who's buying crypto? Who's buying industrials? Who's buying the market? Who's buying this? Who's buying that? To sit and try to figure out what the average of them are doing is probably a waste of time. Look at what the one you're interested in has done and decide whether it's ready to go up next. And what it did last is less important than what it will do next, because you don't own it yet.
All right, Kerry, you mentioned, I think, something about bonds a little bit ago and probably the interest rates. Where do you see this playing in this market right now? Because as Frank points out, you read in the newspaper, and it was about 2 weeks ago, there was this really big scare about selling of U.S. bonds by, they believe, foreign entities and driving driving the price up and the yield down on these, which then I guess does not make them as attractive to other investors. Am I getting that correct?
You have it backwards. When they sell, you drive the price down and the yield up.
Okay, that's what I thought I said. Maybe I
No, you said it the other way around. It's common
right.
mistake.
Yeah.
So
So, we read, we hear about this, we read about this. Is it anything that we should be concerned about?
we have to look at comparisons. Bonds offer a yield. They also offer price change. And the total return is what matters, whether you're in bonds or stocks. And if you're in a well-constructed portfolio, you probably own both. And if the prices of one asset class go down, you become underweight. And in common logic, not emotional, all right, just common, the emotion's what messes all this up. When the price of your asset goes down, providing it's a viable asset, you ought to probably be buying more to get it back up to the weight you wanted it to be. On the converse side, something went up, which became overweight because it went up, and you probably ought to trim it and move that money to what went down so that you keep your weightings in balance. Then the emotion comes in, and everybody starts to try to predict what's going to happen next. And we all here know that's not possible.
Yeah. All right. Go ahead.
So I was going to say, the bond market is very tricky right now. The point that you raised about, yields and what's going on, and the, international players wanting to buy our debt, we haven't seen a fallout of that yet. I don't know that we will, but what I do know is that the bond market isn't really liking what's going on, because what we're seeing is the very short end of the curve, like the short-term interest rates. We've actually been seeing, those yields come down, but we've been seeing the yields on the longer-term 10 and 30-year go up. So if we're talking about the impact of recession, which is, a lot of people would think that's why the stock market is declining right now, because we're concerned that things are going to come to a halt and we're going to have a recession. Normally you would see yields fall across the board, and we're not seeing that. There can be some technical reasons for it. You could have hedge funds that are getting stopped out of positions, and they've got to sell to cover their margin calls. So and we did see this happen, by the way, when COVID hit. We saw this kind of gyration in the treasury markets. So we're seeing that right now. And it is something to keep an eye on, for sure.
Okay.
I usually think, and I always say I hate to admit this, that the bond guys are smarter than the equity guys. And I use guys as generic, the people. Anyhow, and why is this? Well, because they have to make money off of an asset that doesn't have a whole lot of volatility in it, and it can only go up to 100%. If you own a bond, you're going to get paid back at whatever the face value is, right? So the bond people can be, in times of stress, more aware of what is really going on in the world and get direction and magnitude better. But I think Carrie's point that that just weird sections of the bond market are going awry is telling you that there's probably other mechanisms, not the whole bond environment is telling you recession is nigh. So you have to look at not just that bonds are kind of off, but what sectors and what does this really say? So I agree with you, Carrie, that we live in unusual times, and it's reflected in the pricing and yields of the bonds.
All right. So the IMF, I think, meets this week, and so the bond people are really going to be paying attention to that, whatever they see coming out of those meetings, much more than any stock analysts are going to be.
Probably.
Yeah.
Okay. We'll wrap this up with one final area here, and that is the Fed chair indicates that he sees inflation rising with the tariffs, and so he is not anxious about cutting rates immediately. The president, President Trump, wants the cuts now and is threatening to fire Jerome Powell. Powell said, quote, "Our independence is a matter of law," end quote, And those close to him say that he is likely to personally finance a challenge in courts if he is fired. As an aside, the president, by the way, just has about a year left or so, and then he can name a new Fed chair if he can wait that long. So the question, and your opinions on what might happen with the markets overall if the president does indeed fire Jerome Powell. I know it's a speculation, but that's what I like to do. So go ahead.
You're getting into politics, but if the Constitution, not that it seems to matter to this president, says he can't do it, it'll end up in the courts, and his term may end before the courts are done with it.
Yeah, that's probably true. So the act itself does have a stipulation in there that the president can fire for cause, right? For cause. Very, very interesting word these days. We all have a very different definition of it. I don't know how far he will push on this, and especially given that there's a year left. I do think that, hey, you can look at the market like today being down and pick 5 reasons why.
A lot of people are saying it's because of the talks about firing the Fed chair.
It's more uncertainty. That's, it's more uncertainty. And by the way, like, reducing interest rates doesn't change long-term interest rates. Reducing interest rates doesn't change what the 10-year is. If anything, this goes back to what I said earlier, that there's only so many things you actually can do, but consumer behavior and how the markets work are out of an administration's control. So if they do lower interest rates, let's just say whatever happens and they do lower interest rates, that doesn't mean that the 10-year bond is going down. That doesn't mean that the 30-year bond is going down. If anything, there's concern over that separation because the Fed is supposed to work independently of the government. So we'll have to see how that plays out. But it is the uncertainty, right, that really is what's just adding to volatility.
Yeah, and to make a comment that Frank always says, the Fed chair also went out of his way to remind people that protecting equity markets is not part of the Fed's dual mandate. Of course, it's stable prices and full unemployment are what the Fed wants. That's their mandate to do.
Well, and wait, I have something to add too. So the irony alert here is, in the past, let's say 2 months, the dot plot that says the likelihood of a interest rate decline or decrease is getting more and more likely. So I don't know what the big fuss is here. And then we've got, over the last couple of days, which seems like a lifetime, we got really great numbers from CPI numbers last week that show inflation is kind of drifting down. So the Fed would naturally take it from a more restrictive to a less restrictive rate. So I think this is just a lot of chatter at this point, and I'm fingers crossed that that we wake up tomorrow and Jerome Powell is still the Fed head. Although, life's a gift. What can I say?
All right. All right. I think we'll just wrap it up right there. Thank you again for joining us for The Bull, the Bear, and You. And I'm saying that to Kim and Frank and to Carrie and to Michael. And Michael, hopefully we can get your microphone problems squared away. Thank you for staying with us through the entire section. You want to say anything at all? Try it again. No, he's shaking his head. Okay. Well, I thank all of you for joining us as well. And since you're watching or listening to this program, I ask that you hit the subscribe or the like button on whatever platform you happen to be using. Thanks again for joining us. We'll see you again in about 2 weeks for the next edition of The Bull, the Bear, and You.